We always thought that multi-manager is a far better implementation than a single manager hedge fund. We're avoiding this war of talent whereby we're buying PMs from other hedge funds. We do not intend to make them employees of Nickel. Neither we are infringing their IP, which is critical because in traditional hedge funds, if you work for someone and you decide to leave the firm, you have to forget everything which you learned in these walls. Our philosophy here is instead of being East Berlin, we're following logic of West Berlin.
This episode is brought to you by CAIA.nxt. You'll hear more about how you can take the next step for your clients with their alternatives education courses later in the show. Let's get into it. I want to do a quick disclaimer that nothing we say here is investment advice. As well, nothing we say is marketing or advertising for Nickel Digital or any of their funds. Everything is meant to be informative about the industry. Welcome to Other People's Money. I am joined today by Anatoly Crachilov, CEO of Nickel Digital, a London-based multi-manager crypto hedge fund founded in 2018. They started trading in 2018 as a single manager fund and have evolved into a multi-manager as of 2021. They're one of the largest multi-manager funds and certainly one of the oldest crypto hedge funds in the space. So Anatoly, thank you very much for joining me today.
Pleasure to be here.
So you guys you're a multi-manager, you're a crypto hedge fund. You are at the intersection of probably two of the fastest growing segments of the hedge fund space. What was it about the environment in 2021 that had you shifting from a single manager focused on arbitrage to a multi-manager fund?
We always thought that multi-manager is a far better implementation than a single manager hedge fund. And the logic being, as an allocator, you would like to diversify across multiple strategies and multiple trading teams rather than be hostage of one, however brilliant manager, right? So when we started this business and launched the fund in June 2019, we didn't have enough capital to go for a multi-manager implementation. Our month one capital was slightly over $10 million. As we progressed, however, and we hit the first 100 million, we were in a much better position to basically now kind of go in a multi-manager format and by virtue of that, achieve our ultimate goal of diversification. And that's where in 2021, we launched a multi-manager vehicle in addition to the one managed internally. Over the subsequent 2 years, they were run in parallel. And then by 2023, we decided to merge them together. And the logic here was that instead of competing with our pods, right? Because on one hand, you run a single manager fund yourself, and then you observe trades of multiple pods on your platform, which kind of conflicting with these two things. We decided kind of to eliminate this conflict interest and have one vehicle only, which is a multi-manager. But the idea itself, to answer your question, was around from the very beginning.
Do you guys still trade? Like some of the heads of the multi-manager firms still like to trade. You know, Dmitry Balyazny has famously kept a trading account for a long time. Same thing with Steve Cohen. And, you know, at times they have stepped away. Are you guys still trading?
So we do not, and we do not do it by design. In many multi-manager hedge funds, there is a thing called central book or alpha capture book, which is generally designed to overlay trades of your underlying pods. And then the firm, the mothership, would either copy trades sometimes or to some extent create parallel strategies, which may eat into capacity of the underlying pods, right? So there is some kind of an element of competition between central book and the rest of the pods. The way we approach that, we will not be competing with our pods. We will not be running these overlays, and we're going to take capacity as much as you have capacity, if we can really kind of fulfill that. Or if capacity is still spared, that's your capacity and it's your IP. So we're not competing with our pods, and by design, do not trade in parallel. So to answer the question, no, we don't trade in addition to whatever our pods do for us within the fund.
So how many pods do you have right now, and what are the different strategies that they are divided between?
In terms of strategies, we pursue few verticals. It's stock ARB, RV, basis, funding ARB, cross-exchange ARB, HFT market making, mean reversion, and short-term momentum strategies. So the whole range of that. And then within each of these verticals, we would have a certain number of pots, up to 15 in theory, well, kind of, and then beyond, which would compete for capital allocation. And essentially, it's kind of very meritocratic structure whereby the best risk-adjusted returns ultimately win higher capital allocation, right? So in terms of number of pots, we started this year, 2025, with 35 pots on the platform, and we reached 74 by the end of September. So it was over 100% growth in a space of 9 months. How many pods we have on the kind of can have on the platform? We are aiming to get to 100 pods within this year, and then propel it to 150, 200 in the years to come. So from our perspective, this diversification is very healthy because it gives us a breeding ground for incubating pods, observing the way they trade, gain some statistical confidence in their trades before we scale them up or choose not to scale up, right? So from that perspective, the greater number of pods, the greater is opportunity set for us as capital allocator, sitting on top of the mothership, being the fund itself.
What was the impetus for this rapid growth in the number of pods this year? Was there a change in the infrastructure, your ability to manage that many teams at once, or was it something about the environment?
Infrastructure is critical here. And if you look on Nickel, we were 3 founding partners when we launched this business 6.5 years ago. Now we are 30 people in the firm, and roughly half of us are software engineers. The reason for that, both risk management and execution management, as well as margin management systems, they're in-house developments, right? And this is heavy, technology heavy business. The only thing we outsourced in our business was a portfolio management system. But in a sense, this is the least mission critical structure. Risk management, on the other hand, and execution management are the paramount pieces of the whole architecture. So from that perspective, evolution of these systems now allows us to bring 100 pods and 200 pods. Scalability kind of has been solved by now because we invested so much energy and human hours into that, and testing these systems through critical market dislocations. And there were a bunch of them over the last 7 years. Now, the growth which we observed this year was really part of the strategy, because from our perspective, the greater number of pods you have on the platform, the greater your ability, right, to construct a portfolio in the most precise manner. Because as market shifts and as market regime changes, certain strategies perform better than others, right? For example, your basis trade may over deliver at a time of market rally, and then as market goes sideways, basis trade contracts, right? It becomes not appealing. So you should be able to reallocate capital pretty aggressively to other strategies. From our perspective, the greater number of pods you have on your platform, the more kind of optimized you be with your portfolio construction. So it has been a concentrated effort to bring more pods on the platform. And there are a few avenues we're pursuing here. One is in-house talent acquisition team, which essentially screens the market and finds prospective pods. Then we have an external kind of talent acquisition introducer network, right? There are over 10, I think, believe 13 external teams who would kind of introduce us or kind of pods to us, right? And this is another channel. And then the third channel is perhaps our presence on different conferences or podcasts like this one, which ultimately kind of help proliferate the knowledge about us and what we do. And that drives prospective pods towards us, right? So these multiple channels ultimately resulted in increased number of candidate pods. We are still very selective, but nonetheless, we managed to increase, as I mentioned, 35 to over 70. Selection rate is relatively low. Over the years, we have reviewed 1,600 quant teams, generally to have 70 on the platform today. So you would see the selection rate is pretty low, kind of couple percentage points. But that's the nature of our business. We have to test and validate many prospective teams to really kind of assemble a core which will drive the portfolio.
So what is the onboarding process like for a new pod? And really, we should go back to the due diligence process and start there. And then let's say they pass the initial due diligence of like KYC and just do they have the operations in place to even work with you guys? What does that look like? And then, and if you are willing to give somebody a test or a try, what does that stage then turn into?
Whenever we have a new team coming kind of with the existing strategy, the way we test them, we first look on whether there's significant presence of beta in their portfolio, because we are market neutral guys. Generally, we would not allocate to strategies which have directional exposure, a part of some what we call asymmetric cases, which is still relatively small percentage of our portfolio. Majority of the book is market neutral. So first, what we look through is really what are the underlying strategies, right? How was the correlation with the existing Bitcoin, crypto markets, equity markets even, right? Because ultimately portfolio runs at negligible correlation with SPX and Bitcoin. Over the last 12 months, our correlation was 0.01 negative to Bitcoin. So basically it's non-existent. That's something we're very sensitive to. So if a given strategy brought by a new prospective team overlays well with the existing portfolio, ideally it should be negatively correlated or at least loosely correlated. That gives us a first reason to kind of consider this seriously for the portfolio. Now, there are a bunch of different elements we would review it against, but if the allocation is, if the decision is positive, we can make this allocation. We would have even an immediate kind of sizing of that portfolio. It may be like potentially would like to allocate 30 million to your book. Realistically, everyone starts with a test capital before we have statistical confidence to scale you up. And in our case, nothing personal. Everyone starts with 100K. And 100K is not the amount you're looking to manage as a manager. Neither, believe me, I'm losing to waste my time as an allocator. But I need to validate whatever we've been told and the track record we've been shown first kind of in a real life under our supervision before we take a proper risk and scale you up to 30 million, right? So the methodology here is 100K is allocated on our sub account. And generally we're saying like, you tell me which exchanges you're trading at. And usually it would be kind of few major exchanges. So we would open sub account of our existing fund account and would load 100K into that. Now you have flexibility to move capital across these exchanges. You don't have flexibility to withdraw capital. Naturally, you have trading API, not withdrawal. But now as you start trading, we have ability to oversee these trading on a millisecond basis, right? And given that all of our pods would be mid-frequency to high-frequency guys, in the first few months, usually it's 2 to 3 months, they would trade at least 100,000 individual trades. And now you have statistically significant data set to pass a judgment whether this trading style matches what was the original pitch, right? And more importantly, you would like to see how the strategy reacts to different market dislocations. Friday of last week was ideal testing ground, right? When you have multiple strategies going through extreme distress scenario. And then you can have a perfect visibility. Are you willing to scale this strategy or you would rather not to proceed, right? And fair enough, not every manager makes it through the test allocation. And at that stage, if they don't, we just scale it down. Or if they do, it goes to 1 million to 525, right? That's scaling plan. And everyone has a clear visibility on the scale plan. It's subject to performance metrics, and the timeline is very well defined. So that's the logic which every single pod goes through.
And how does the fractionality of crypto assets impact your ability to start people out with such a low amount of capital? I mean, the 100,000 compared to the starter capital a pod in traditional finance gets, it's so much lower.
That's exactly the point. The fractionalization of crypto allows you to run strategy on 100K as perfectly well as you can run it at $50 million, right? Specifically in traditional space, if you trade natural gas contract, the minimum ticket is $3 million, right? So you cannot really experiment with the small amounts. In crypto, you can. You can replicate perfect strategy on 100K on 100K capital allocation, and that's the beauty. It allows us to test before really take the full risk. And if you think what 100K is in the context of fund we run, this is 5 basis points, right? So if even a candidate manager would blow 20% of the initial allocation, it's 20% of 5 bips, i.e. 1 bip. I can handle this risk, right? But it gives us ability to test, validate from multiple angles before really take a proper, meaningful risk on the board.
The asset management game is changing. Increasingly, alternatives are eating into both stocks and bonds, becoming staples for all types of portfolios. With over 25 trillion already in alternative investments and 20 trillion more projected in the next few years, clients expect more than surface level knowledge when it comes to alts. That's where CAIA.nxt comes in. It's a self-paced learning platform designed for financial professionals who need to understand and speak credibly about hedge funds, private equity, private debt, digital assets, real estate, and more. You'll learn directly from the leading allocators and alt managers shaping today's capital flows. So what you learn today, you'll use in your next client conversation. Whether you're an independent advisor or trying to get ahead of your peers in a larger organization, CAIA.nxt gives you the edge to stay relevant. Visit the link in the description to get 10% off and start mastering alts for your clients. Be future ready with CAIA. How do you determine whether that strategy is not going to scale? I mean, certainly there are things that you can do with $100,000 that you can't do with 50 million or even 10 million.
Absolutely. So this is one of the conversations we have in the very beginning, and usually managers would have feel as to what is the capacity of the underlying strategy. And very often the conversation can be like, well, the strategy can absorb 50 million. And even we may be doubtful that that can take 50 million, but hey, we can scale you up and see what is the inflection point. And it well may be that actually at 20 million, that's your real capacity. You thought it was 50, but realistically it's 20, right? And at that stage, we would pause any further kind of scaling of a given manager just to avoid dilution of returns, right? Because this is the most optimal point. But we have ability to kind of observe performance and risk metrics as we scale up, right? Whatever is the initial expectations, the reality will show you and dictate the real allocation.
What is the sort of low size of a pod that's worth you taking on versus the increased burden of monitoring that pod?
So our largest allocation today is 50 million. Our minimum desired allocation is perhaps 5. If the strategy cannot absorb 5, we perhaps wouldn't engage. But ideally, we would like this to be 10, 20 million allocation per pod. That would be kind of our ideal scenario.
Now, what about risk-adjusted returns? What is your preferred metric? Are you Sharp people? Are you Sortino people? Calmar? What do you use? What's your measuring stick? And what do you like to see from people to say, hey, this is something that on a risk-adjusted basis is going to be attractive to our portfolio? And then are there any considerations with correlation where you'd say, hey, this is maybe below our standard risk-adjusted basis, but it's so uncorrelated from everything else we're doing, we think it adds value?
Absolutely. So we think in terms of Sortinos. Why Sortino? If manager has an outstanding month and over delivers and should save 15% in a given month, kind of we will take that, right? We are happy to have upside vol as long as it's within the expected returns, right? Kind of because some of the strategy, if they over deliver, that's also a matter of concern. But fundamentally, kind of upside vol is fine by us, but we are very sensitive to the downside vol. So from that perspective, if you use Sharp, you would punish your manager for both upside and downside vol. Sortino punishes you only for the downside, and it's better fitting into our strategy. Now, with the managers, we have the a payout structure which actually is linked to your A, gross performance, and B, your Sortino ratio. And intersection of these two defines your ultimate payout, right? And this is defined in our case on the quarterly basis, and you know exactly how much you're going to be paid. The higher Sortino you manage to achieve during this reporting period, the higher is profit share you retain as the portfolio manager. And again, kind of Sortino is a better measure in that context. Now, the minimum what we are looking for is Sortino of 2 with our managers to achieve a significant payout. And we are happy to be the most aggressive on Wall Street and pay up to 50% of P&L to our managers. For that, you would need really to deliver an outstanding returns with Sortino of over 10. Is it doable? We have quite a few managers on the platform who do that. But generally, kind of, it's a very high bar. Entry bar is Sortino of 2, right? Would we take managers with the lower than that? The answer is yes. And it's exactly to your point. It may be a great diversifier to the portfolio. And from that perspective, we kind of would tolerate lower sharp slash Sortino in favor of some diversification benefits. But generally, the guidance is Sortino of 2 with return of 20% plus. Why it's 20? We're guiding our clients for 15 to 20% net returns, which implies the underlying pods should deliver above that, which means 20/25% as a target return on the pod level.
So I know you have a standard 2 and 20 fee model. Is that 50% of the 20%, or is it you're willing to pay above even what your clients are paying for truly exceptional performance?
So the way we think about our relationship with the pods is this is a partnership whereby we're contributing uh, EMS, RMS, relationship with auditors, fund administrators, regulators. We're giving you capital. All we're looking for from the underlying pod is the signals, right? Kind of the model which they have developed. So from that perspective, managers would retain certain part of the P&L they generate within this partnership with us. And it can go from 0 if it's relatively mediocre performance, right? With say below 5%, I can get 5% in US treasuries. There's no point of paying someone for that, right? But for the exceptional performance, it's going to go up to 50. So essentially managers at source would retain part of the P&L. Now, whatever we're getting out of this partnership, that is subject to 2020. So from one point of view, you can say this is a double layer of fees, but realistically, that's how the world works. When you look at Millennium or Citadel, PMs who are part of these firms, if they deliver within the pod they're managing, they would have a cut at source, the same 20-25%. It may be not as aggressive as we're willing to go for, but still 20%, 25 will be retained by pod. And then it goes into 2020 by the firm itself, right? So basically here we're using the same logic as every multi-manager uses in traditional space. The only difference is perhaps we do not go for the pass-through structure. And the pass-through in traditional multi-managers is any costs which are emerging out of hiring managers or retaining them or any other major cost would be passed down to the investors, right? And out of net of these costs, there is still 2020 or maybe not 2 because kind of there is no management fee. There is also, however, there is kind of massive pass-through costs, but 20% performance still applies. In our case, given that we're not hiring these managers per se, in our structure, all managers are external by design, right? So then they're not becoming part of Nickel team. There is no cost of buying them out from another hedge fund. And from that perspective, there is no massive upfront cost, which we have to pass down to our investors. From that perspective, this is a far more cost efficient structure, right? But the netting costs, which are emerging because of multiple managers on the platform, yes, these costs are passed down to the investors.
So beyond the higher split that you're willing to give compared to the competition out there, What else are you doing different to attract talent? I mean, this multi-manager game, it has been described as a war for talent. What are you doing to try and win that war?
There is significant shortage of talent in the industry. Or put it this way, kind of, if you look on traditional space, there is a massive war when managers would move from one firm to another, and that creates this price competition for talent, right? Which usually can become extremely expensive. And FT, I believe, reported this. FT or Bloomberg was showing up to 100 million cost of attracting a given manager. Now, in our case, we're saying actually talent is distributed around the world, perhaps pretty equally, right? Opportunity set may not. And from that perspective, we shouldn't be really concentrating our search into the vicinity of London or limiting to the vicinity of London or New York for that matter. We should really be open to the world. And if we find a great team sitting in Hong Kong, Singapore, or South Korea, we would be happy to allocate capital to these teams, right? So from that perspective, our coverage is much broader. It's a truly decentralized model rather than heavily concentrated in any given financial center. And second, it's really kind of designed on this premise that I respect your desire as a PM to retain your independence. Because if you are a truly great trader and you run your prop capital, you are very unlikely to be willing to join another firm and become an employee. You want to run your shop and have your name on the door rather than someone's name on your door. And we respect that. So from that perspective, we're still kind of gaining access to the talent, but we do not intend to make them employees of Nickel. Neither we are infringing their IP, which is critical, because in traditional hedge funds, if you work for someone and you decide to leave the firm, you have to forget everything which you learned in these walls. In a sense, kind of, you were a salaried employee, and whatever you've produced as an IP remains property of the firm. We're saying that's kind of unfair because you kind of committed years to build this IP. And in our case, if you decide to leave, of course, IP is yours by design, by definition. So from that perspective, we're avoiding this war of talent whereby we're buying PMs from other hedge funds. Instead, we're looking at this as a partnership with different talented traders around the world. And that's sort of kind of a differentiator in our case versus traditional hedge funds.
Well, even if you let them take the IP, what about non-competes and the garden leave aspect that's also become very popular?
Yes, in traditional space, it's easy 12, 24 months. Some of the firms were trying to even kind of lengthen this non-compete. In our case, we're saying we will not be imposing any restrictions. So there are no non-competes, no sit-outs, or anything which limits your ability to manage capital outside Nickel. And our philosophy here is instead of being East Berlin, we're following logic of West Berlin. The logic here is like instead of locking people and creating different barriers around them, we're saying no. As in the West Berlin, we're going to create a reason for you to stay with us, right? We're going to give you, I would say, well, indeed, kind of this logic is to create the most lucrative environment and comfortable environment for you to work with us, rather than restrict you heavily on your right to movement. And I believe long term, this is a better strategy, right? And managers really stick with us because A, we play fairly, and B, we give them kind of full respect to the IP they deliver and they produce, rather than trying to limit or restrict in any fashion whatever they have produced as the managers.
So one of your managers could run a single manager fund side by side. You have no issues with that?
Correct. We're not demanding exclusivity. Our typical manager would run prop capital. Usually it's a group of 2 to 3 professionals. So they would run prop capital, possibly third party capital, and our capital. And from that perspective, we're not demanding this to be only our capital, because that creates a relationship whereby they're fully dependent on us, essentially becoming our employees, which this is not the intention, right? And if you look on our majority of our PMs, they would be former managers from traditional hedge funds who used to run equity, fixed income, commodities, discovered crypto as a side business, perhaps kind of on the PA account, and realized, geez, that's where the alpha is. This market gives you completely different opportunity set. And they would leave traditional space and now run prop 20 million capital of prop capital, prop book, which is extremely yielding, but very capacity constrained. So from that perspective, launching a full-blown hedge fund might be slightly counterproductive because the total capacity may be 50 million, right? So you would not launch a fund for extra 30 million. But coming to us, we're going to fund this 30 million without expecting them to launch a fund or any vehicle, because we are not fund of funds, right? From that perspective, we're not relying on their infrastructure. We're offering them capital on our existing framework, on our existing platform. And this is where it's so complementary to each other. There are prop capital plus the same strategy applied to our capital.
Okay. And to take your East Berlin, West Berlin analogy, have you had cases where people say, I'm done with the city. I've made enough money here. And, thank you, Nickel, for all that you've done, but I'm just going to run exclusively prop now. I have a 10 Sortino strategy and I have limited capacity and I have enough money now to fund it myself.
That's absolutely a scenario which can be, right? Kind of if they've run out of capacity and carefully their internal capital takes over the entire space, they would part ways with us. Or alternatively, they can raise capital in unlimited volumes from outside, right? And my 50 million is not really value added anymore, which is great if that's the case. Realistically, it happens extremely rarely, right? Because raising capital in crypto is still challenging, is a difficult exercise. And as market expands, generally capacity rises as well, and our capital still remains extremely relevant for their businesses. But you're absolutely right. We can face a situation whereby a talented manager got access to massive amount of capital, right? And then we can lose this manager. There's a way we can counterbalance that. And one of the approaches here is to have significant amount of capital, which backs us as Nickel and can provide kind of write a significant ticket to a given single manager. Within the existing fund, it might be a constraint because if you have a certain number of managers on the platform, you cannot really give the entire fund to one manager, right? That's going to kill the diversification element. However, you can create a fund of one and fund one exceptional manager with $100 million, right? As long as some of the allocators are willing to support or bet on a particular manager. So this would be done outside diversified alpha, which is our kind of well-diversified vehicle. But this is something we can do to retain exceptional managers who have massive capacity and can absorb $100-200 million. Now, via fund of one vehicle, we can address this potential risk, right, of them departing because we are, as Nickel, cannot provide or cannot take the entire capacity.
And have
But
your clients expressed desire to do that? And do they look at you in many ways as a talent incubator, and they can come and tap you on the shoulder and say, hey, we really want to scale these guys up and do it, with you?
yeah, so majority of our investors, we have over 100 investors today, would look at us as a diversified bet on market neutral strategies in crypto, right? However, there are other players who are willing to take more concentrated bets. And that's where this availability of capital emerges to back certain managers, highly performing with significant capacity. And there's going to be a standalone value proposition in addition to diversified alpha, which is generally kind of put it this way, kind of for majority of allocators, this is more desirable, diversified exposure. But there
All
are
right.
a upset of allocators who would be willing to take more concentrated bet.
Let's talk about raising capital, the demand for a market neutral multi-manager crypto product. What were things like in 2021 when you started compared to today? How do how do your clients feel on moments like last Friday? We're recording on October 17th, so I think the last Friday we're referring to is October 10th, the day that Donald Trump decided to reopen the sort of scuffle with China as it relates to tariffs. Um, what are they looking for today? What were they looking for then? And what are your conversations with them like?
Yeah. So 7 years ago, 6 years ago, it was really about why crypto and whether the crypto has the right to be part of the portfolio allocation. So we spend a lot of time trying to bring this to demystify the whole crypto ecosystem and deliver the logic as to why you as an allocator may wish to kind of underwrite certain alphas coming from crypto market. Uh, Initial allocators were primarily family offices, multifamily offices, and some fund of funds who were kind of crypto fund of funds rather than traditional fund of funds expanding into crypto. So that was the original group of allocators. And why family offices? Because generally you have one or two principals who are able to underwrite these decisions. On the other end of the spectrum, if you have pension funds, it's a far more complex approval process, right? First of all, they're agents rather than principals. So basically, they have to go for multiple investment committees, and every single of them, the portfolio managers underwriting these decisions, they might really see this as a career risk. Why the heck are you engaging with this new untested asset class? So whilst I had a enormous amount of calls with pension funds. Every single of them, in my understanding, was kind of an educational journey rather than our expectations they're going to be an immediate provider of capital. And that was kind of a fair assessment, right? But now we're seeing quite a few of them coming back saying, like, hey, with the current changes in the US and some clarity being brought by Genius Act and the forthcoming Clarity Act, political risks are completely different to what they used to be 5 years ago, right? Now we're willing to kind of take a careful look and actually move from intellectual curiosity towards actual allocation. And today the conversations are going, in addition to the same family offices and multifamily offices, we have now proper fund of funds allocations from multi-billion funds from traditional space who have made their first steps into crypto and allocating through us, right? We have university endowments and multi-billion endowments again, who have done their homework over the last few years and now are prepared to engage with real capital. And the conversations are with sovereign wealth funds. This group of allocators is also pretty conservative, but kind of the understanding is that this asset class is here to stay. We should be able to take a view and underwrite certain type of risks in crypto. So basically, what we are saying, there is kind of much broader group of allocators who are now looking at digital assets as a legitimate allocation. B, the thought has evolved internally, right, to basically make decision of allocation rather than just researching this space.
You mentioned regulatory risk and that seems to be subsiding, at least here in the US. I'd be interested if you feel differently about the rest of the world. Certainly, that was something that here in the US, if you talk to folks who were involved in crypto, they were saying, we're going to lose if we don't do something about the regulation here. Where the talent's going to go somewhere else. This industry is going to plant its roots maybe in Asia, maybe in London or somewhere else in Europe. Um, it feels like that tide has reversed rapidly in this past year or so. But looking back, there were other risks. Obviously, you've gone through FTX, you've gone through multiple bear markets, and you have position level risk. So, as a firm, how do you think about all of these different risks?
So On the regulatory risk and political risks, certainly kind of the change in the US is profound, right? It's like 180 degrees to what we saw 2 years ago, a year ago, right? US is not the only jurisdiction which leads the way. United Arab Emirates, specifically Dubai and Abu Dhabi, are very aggressively on this path. And I do like seeing this kind of competition between major jurisdictions. And this is very helpful because in both of these jurisdictions, you see rise of A, crypto hedge funds, and B, allocators who are willing to engage now, right? And sovereign wealth funds in Middle East are pretty open-minded to this logic of allocation, partially because of the local regulatory environment being so kind of well structured and constructive. As to FTX, these risks, to my mind, were primarily, how to say, infrastructure risk and being an offshore exchange as FTX was, right? Certainly they were not part of any proper oversight. And ultimately we ended up in straightforward misuse of clients' capital by people who were in charge of running the exchange. I think these risks are largely addressed now through not an element of trust, but through the element of off-exchange settlement or tri-party agreements whereby capital never touches the underlying value. And very often in our conversation, our prospective clients are bringing up this question, like, how do you trust these exchanges? And our honest answer, we do not. We don't have to, right? Because capital never has this kind of counterparty risk. We don't run counterparty risk with the exchanges because capital never touches them. Now, the logic is it sits with third-party custodian, and if exchange goes bust, fundamentally, from our perspective, it's an element of massive inconvenience, but not a loss of funds. And that's what is important, right? So again, there is nothing new here. This logic of segregation of trading venue and custody services is part of the normal structure in traditional space, right? Whenever you trade on NASDAQ or NYC, your capital never kind of held by these trading venues. It will be held by JP Morgan, State Street, or BNI Mellon as major custodians. And settlement is taking place between the trading venue and your custodian. So essentially, crypto moved exactly the same path today. And you see this emergence of qualified custodians who would hold client capital. In our case, this is Copper, Fireblocks, Signum, and soon to be BBVA. But ultimately, we're going to have BNI Mellon coming to this space. And generally, that's going to be the area of, over time, perhaps least of concern to our clients. As of today, it's still a primary concern. How do we safeguard the assets before we kind of expose our capital to any strategy? And when you talk today about this custody services, we have to spend some time just to drilling through the structure, how the capital is being held, who are those newly emerging crypto native firms. Once you have majors coming into this market to the tune of BNI Mellon or State Street, that will become a non-issue. People would focus on what matters, and what matters is the strategy itself. But this is part of the evolution, right? We're moving towards that.
How accessible are these custodians and third-party settlement systems for traders today? Is it something that institutional firms like yourself only have access to? And is it creating a bifurcation or a tiering of the types of people who are managing third-party capital in the crypto ecosystem between those that have access to these systems and those that are doing things maybe not exactly like they were pre-FTX, but closer than an allocator might be comfortable with?
So for people like ourselves, third-party sort of tri-party agreements and off-exchange settlement is a non-negotiable structure. We have to have it every single exchange we're trading at. And honestly, I would expect all the traders to follow the same logic. You cannot expose kind of capital, which is you are managing on fiduciary kind of relationship to this unnecessary counterparty risk. Now, if you trade your pro capital, you can take whatever risk you want, including counterparty risk with second and third tier exchanges. But in our case, managing in institutional manner, third party capital, we cannot underwrite those risks. That's why in our case, it's a part of the structure we would not compromise ever. Now, whether this is a widely accepted formula, I believe across all serious institutional hedge funds, the answer is yes. Across retail market, likely no. Majority would take kind of counterparty risk with trading venues, including sending your capital to Binance, OKX, and other exchanges. Kind of nothing wrong with that if you are prepared to carry this risk, but we do not on this on the level of fund. So from that perspective, yes, institutions follow all exchange, retail market likely to ignore this risk and still kind of send margin directly to the trading venues.
I want to get into capacity overall in the crypto ecosystem and the relative size between crypto hedge funds and their counterparts in traditional finance. How big do you think you could be at the current level of pods, and then as well with the target of getting up to over maybe 200 pods? Has that been driven by a desire to expand your asset base? Clear demand, clear line of sight to that asset base rising. Uh, where is that heading?
Yes. So, generally, kind of in every asset management business, AUM matters. Ultimately, this is your firepower. In our conversation with the underlying pods, we have to give them freedom to perform. And if the capacity is there and performance is there, I would like to fund this to the maximum of my single manager allocation, which ultimately results like what size of funds do you run, right? So that what's your minimum maximum allocation per manager? So from that perspective, of course, we have to grow, right? And that is to some extent my commitment to the underlying pods. Now, capacity in this space will likely to be a problem for the foreseeable future. In a sense, you can deliver very meaningful returns with high Sharp, high Sortino type implementation, but it's not to the to kind of to the tune of throwing $1 billion at that sort of risk adjusted returns. So from that perspective, yes, the way we can scale our business is via adding additional pods, and each pod should be able to process certain amount of capital. The greater number of pods you have overall increases your kind of allocation on the fund level. So this is one of the avenues. Second avenue is execution. The better execution you have as the firm, potentially that unlocks or kind of that improves P&L of your underlying pods and unlocks additional capacity, right? And to that end, what we've just done, we have partnered with a major a Chicago-based market maker, prop firm. We have not disclosed name yet because we're finalizing the legal part of the of our deal. But fundamentally, once implemented, that would give us ability to access their low latency infrastructure, essentially for our pods, to leverage this extremely efficient execution structure to kind of improve their respective strategies, right? And that will unlock additional capacity significantly. So this is the second avenue. And the third avenue, of course, is the market expansion itself, over which we have no say here, right? And no control. But fundamentally, as market expands, as you have greater depth of the market, greater number of derivative instruments which are being launched and now becomes liquid enough for us to engage, that increases your capacity as well, right? So all these three avenues ultimately should allow us to go 1 to 3 billion and beyond, right? As we keep expanding on this path.
And how much do you think people are giving up in terms of execution? Like how much slippage is there?
Depends which instrument you trade at which venue and under what market conditions. Because the event which you mentioned last Friday, it certainly was a distress to the industry. And whenever you see that sort of inefficiencies emerging in the market, the spreads just blew, right? Kind of blew up. The bid ask at some of the venues was 250 basis points, which is very unhealthy. And certainly kind of trading in that environment is hugely inefficient. From our perspective, we can take advantage in some of the circumstances. If market goes in that sort of dislocation, but generally you would experience significant slippage here, right? In the normal circumstances, it's a market became relatively efficient. Is there room for improvement? The answer is like, yes, there is still room for improvement. And the way we kind of see that some of the pods which are trading through us on our platform, as I mentioned, they also manage their own capital, right? Usually this capital is not part of our ecosystem. It would be traded directly on different venues. So basically, from their perspective, they have this, I would say, two branches. Part of the capital is traded directly on, say, three venues, and our capital trade on the same venues via our infrastructure as nickel trader. And then some of them came back saying like, it's such an interesting observation. We're trading the same strategy via two channels, and the P&L is materially different. And apparently, in some of the cases, it was up to 12% annualized difference, which gives you an interesting observation that trading through nickel infrastructure actually adds massive value. First question is why and how? And one of them is economy of scales. And given that we are trading multiple strategies under one umbrella fund, all these trades are part of our volumes, right? And that gives you, last year, we traded over $100 billion, right, as nickel. So basically, with that sort of volumes, you are by design sitting on the top tiers across multiple exchanges. And even if you come as a standalone manager trading $1 billion a year rather than 100 billion, right? Generally, you wouldn't be able to access that sort of fee tiers. But being part of Nickel platform, you by design gets the same fee tiers as everyone else on the platform. And suddenly your strategies become more profitable, right? Because your execution is far more refined than what you can achieve directly on your own. And that's part of our value proposition, right? But ultimately, what managers are getting is better execution, lower slippage, and stronger P&L. And the ask by some of these managers was like, can I bring my capital, my PA capital on your platform? In addition to what you gave me under management, I would like this capital to sit on top. The reason being better execution, right? And lower slippage.
And do you allow that as sort of one of the perks?
This is kind of still in conversation, not yet, but potentially we can think of a structure.
I want to shift to the current environment. What is the current environment like for fundraising in crypto? 2025 is a weird year that came in with so much enthusiasm because of the change in the regime here in the United States with President Trump being such a pro crypto president and what that's meant for regulation. And at the beginning of the year, obviously, the performance of the asset class was headed in that direction. It's been kind of stagnant, and not necessarily like a big bear market like 2022 or anything like that, but people play the relative game when they look at what's happening in gold and many other asset classes. And I was talking to a friend who was a crypto investor last night, and I was like, "You're flat on the year. I mean, it feels like you're down, but you're not really down that much." But people play that relative game, so I'd be interested what the fundraising environment is like right now, and then also from your managers, how they're going through this period that's been pretty choppy.
Yeah, so that's an interesting observation. We are seeing quite a few managers, right, at the same time, and having this perfect visibility in 70 portfolios, you can kind of track their performance over time. And we have to admit, this year has been tough for absolute majority of our underlying PMs. And don't take me wrong, we're seeing one of the best, right, who are managing capital, selected out of 1,600 of them whom we reviewed over the years. And yet this year is very different to 2024. Those managers who outperformed last year are struggling this year, right? So they're either single digits up or flattish or slightly negative. So kind of very different, contrasting picture to the previous year. Uh, what they attribute this to is a lot of white noise in the market with Trump for bringing this tariff chaos. Certainly, many of the statistical interdependencies between individual assets have broke down, and that means that your stock art models are not recognizing these new patterns, right? And there's too much noise in the market, which actually impacts ultimately ability to extract alpha from the market. Will market adjust itself? Of course, right? Kind of as this becomes a new normal, these models absorb this new information and ultimately take different decisions to what they've done 12 months ago, right? And that improves ultimately their positioning in the market. So from that perspective, we saw some reversal in the recent couple of months for managers who suffered deeply in the second quarter of this year, right? And even something which was gained in January, February, they gave up in the subsequent few months, and now hopefully went for this J curve on the recovery path. In terms of fundraising, as I said, on the kind of on the regulatory front, we have now much better environment for people to engage, and that allows us to raise capital in in not it's never easy, right? But
Yeah.
perhaps kind of the conversations are more constructive than they used to be. Now, we haven't been raising capital this year for the simple reason we have been so closed for a while since February this year, right? And in retrospect, that was the right time to soft close for two reasons. A, we had significant inflow of capital at the end of last year, and we thought it would be prudent not to kind of dilute the returns, but rather kind of s- not suspend, I wouldn't say suspend new fundraising, but don't accept new capital until you have a clear evidence that with this increased capital base, you can still deliver target returns. So that was one thing. And then ultimately, if you look from February onwards, actually market was in a pretty kind of non-constructive shape, pretty bad shape, I would say, which wasn't perfect for the strategies we run. And from that perspective, being soft closed made perfect sense. So we were not rushing to bring capital in the environment which is not very conducive to the strategies we run. So from that perspective, it was the right thing to do to be in a soft close. So we are in a conversation with multiple parties, and it's more let us kind of go for the homework and let you finalize ODD and EDD on us, but do not write checks until we reopen the fund, hopefully later this year. And that has been quite constructive conversation, right? But I would say kind of generally a fundraising environment has improved dramatically from what we saw a couple of years, 5 years ago.
And in a year like this, where people are struggling, they need to update, adapt their models to the new environment. What are you doing at the risk level, at the central risk level? Does capital get spread out more evenly? Does it just come down the level of risk? I assume you probably have access to leverage to as well to lever up the capital base you have. Or is that coming down?
So generally, the strategies are not heavily levered. The ones we run, we don't borrow capital, put it this way, right? There is an implicit leverage via use of derivatives, including futures and perpetual swaps. So this is something, of course, which is being used to optimize capital allocation and efficiency of the capital. Now, with some of the managers being under stress or kind of delivering low single digit returns, we're not in rush to throw capital at them, right? But we're not shying away from reallocating capital to middle, basically, even kind of sitting in US treasuries, which is not really our target return, right? But ultimately, we're in the business of how to say, responsible capital allocation to pods rather than pushing capital for the sake of allocation as such. So in our case, when we bring new managers and we test them. If the test can be 3 months, that's fine. If it has to be 6 months, it's perfectly fine by us. We're not rushing to allocate capital. We're only willing to take a meaningful risk with any given manager when we have statistical kind of confidence in their strategy, which means we have to oversee hundreds of thousands of trades and see them reacting to different market regimes. And very often the allocation scale up from the first dollar until they're fully allocated may take 9 months, 12 months, right? And from our perspective as capital allocators, that's perfectly fine, right? Am I willing to to allocate capital? Of course, this is my core function, right? Kind of capital allocation, but rushing is not part of this equation. So from that perspective, yes, I would say we saw times when the capital was allocated, how to say, more efficiently, when there was a greater demand for capital and actual equation. Because if you think we have to kind of balance two parts of the equation: A, managers on one side, and capital availability, a LP capital we are raising from external world on the other side. And in some stages, we were in a situation whereby there is not enough capital to allocate to underlying managers, right? And this year we were in a slightly different situation when there is significant LP capital, but not enough capacity on the managers level to push this capital into productive use. And that's fine, but we have to kind of balance this. So as I said, this year was relatively challenging in terms of allocation. But again, the way we approach that, bring more managers, test them, right? Kind of gain this track record with them, because time will change. Market will become more constructive, but we're going to be in a good position to immediately deploy this capital because we have tested 70, 100 different managers by then, right? Even with the small allocations, but we have enough confidence to put the proper 20 million plus allocation.
Does the testing environment impact, like, do you find that people who pass the test in a tough year like 2025 tend to be better than people who maybe pass the test in a year where all of the PMs are making money? Not that it's ever easy or free money, but do you find that it's like, hey, let's do more testing now while it's hard?
Absolutely. I think it's far difficult to go uh, through the funnel at the hard times like we are going now, rather than the time when everything rallies and every single manager becomes a star. So from that perspective, yes, this is a great testing environment. And coming back to Friday, that was one of the hardest tests you can think of. Uh, Funnily enough, I had a meeting with one of the potential allocators a week ago, and I mentioned that whilst we're testing pods in the first 3 months, ideally, I would like market to go through the significant correction and see how these portfolios react to that. And he gave me a call on Monday saying, like, you've asked for one. And and here was the kind of the mother of all sell-offs. And the answer is yes. And from our perspective, it immediately separates sheep from goats, right? And you have some of the managers who did not pass the test, and we had to stop, I believe, 6 spots, right? Great news that all of them were in a testing stage, which means kind of relatively low statistical confidence in them yet. But on the allocation front, it's 100K, right? So kind of I'm perfectly fine to stop any pot when they're still kind of on a small allocation. It would be more painful if they had full allocation by then, and then you have to stop them out. But in our case, all of these pods, but one, were kind of in this testing stage, which is kind of ideal. We don't have to test them anymore, right? Kind of this test was perfect, and we decided not to proceed. The great news is that we had quite a few pods in the scale up stage, which still kind of moving from this a million to 20, 30 million, right? And out of these pods, 9 were brilliant, right? So basically, this reinforces our confidence in their performance and certainly kind of their path to full allocation, if any, will accelerate from now on because they've gone through the greatest test of them all. I'm happy to report that on the full-scale allocations, all of the pods have performed extremely well. And from our perspective, that's exactly what we see. From time to time, I would like to have these distress situations to basically validate the way systems react and handle these massive volumes of trade. Because on that day alone, I think we've traded $10 billion, which is kind of outside our normal daily volumes. But when systems goes through that stress, that's a nice validation, right? If any, we have kind of the system allowed us to be in control at every single second of this distress event, which lasted for a number of hours. And then also kind of the good thing is, as we were going through that night, we have made a list of things we would like to improve going forward, which would allow us to easier reaction to a similar scenario in the future. So basically, coming out of that night, which was quite sleepless to a few of my colleagues, right? It was a happy night ultimately, but sleepless. It gave us a confidence in a number of pods which are already on the platform, and a list of things to do kind of on optimization on the software we run, right? To basically kind of get, how to say, kind of improve our ability to manage the risk going forward as these events may repeat themselves in the future. We hope they will not, but we should be ready for that.
Fortunately, it sounds like your fully scaled up pods didn't flop out in this particular event. But I'm sure there are times when maybe they don't, fully blow through all of their risk budget, but it's worse than you would have liked. There are some places that have very strict, if you hit this level, you're done and we're never talking to you again. And other people feel differently. So if you have had a long-staying relationship, somebody has been a consistent money manager. They've been through multiple stress events before and done well, and then they have a stress event that doesn't go as well. How
Mhm.
do you react to that? Because some people, there's very differing views on it. Some people are very one and done.
So generally, we would look at few metrics with each of the pods. It would be max drawdown, beta, leverage, gross, net, and this is systematically controlled on our side, right? We expect you as a pod to control risk on your side as well, right? And if you have a drawdown limit of say 10%, you should never ever come close to 10%. If you do, and if you go for the limit, we're going to stop you out. And that's something we cannot forgive. In a sense, kind of risk management is something which are very sensitive to. Now, if there is a technical issue because of the exchanges temporarily blackouts, right? Or some other issues when your gross exposure can go beyond the pre-assigned value, or your net exposure temporarily widened outside the bandwidth which has been pre-agreed. Kind of, we're happy to sit and discuss as to why that happened, but that may not be the reason for us to end the relationship. But inability to control risk and inability to control downside, sort of drawdown, perhaps something we're less kind of willing to negotiate or kind of or forgive. So from that perspective, if you break through these hard limits, that's likely to be the end of the story. So risk management is something we are very mindful. This is, if you think we are risk managers, first of all, right? Because we outsource the investment management company to our underlying pods, but we are in the business of A, manager selection, B, incubation and scale up, and C, risk management, right? So that's our core functions. And we expect managers to be mindful of risk they're running on a millisecond basis rather than kind of force us to stop them out. Because if we are giving them a call, this is the firing call essentially. We expect them to be responsible and scale down the exposure if they need be, if the model, for whatever reason, accumulates losses, rather than go through the stop losses, stop limits without really mindful approach to risk management.
All right, well, we'll leave it there with that sort of statement of tough love. Anatoly, thank you so much for coming on the show. I really appreciate it. Where can people find you and find more information about nickel?
The easiest ways perhaps is our website, which is nickel.digital. We are also quite active on different podcasts, articles, and LinkedIn. We look at LinkedIn as more window of opportunity to talk to the world in terms of demystifying what crypto is, right? For some, crypto native is less relevant. For some of the traditional allocators, that's something they're researching, right? So this is one of our communication apps.
All right. Well, thank you very much. And look forward to do this again as you grow and as this ecosystem evolves.
Many thanks. It was a pleasure.
Thanks for listening. Remember to check out CAIA.nxt to level up your alternatives knowledge today. Visit the link in the description to get a 10% discount and learn about what's next for your clients.
Oh.